Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Let's take a look at the example. The last time we saw an improvement in the current account deficit, it started in early 1987, 86, 87, and we saw it start to improve. And as I said, this is money coming out of the global economy. And when you look at improvements in here of the U.S. dollar-based credit coming out of the global economy, it usually means bad things for asset markets. And sure enough, 1987 U.S. stock market crash happened right in here when we started to see improvement in the U.S. current account, kind of part and parcel. We had a little thing called the Asian financial crisis as U.S. dollar-based credit was coming out of the world. We also had the U.S. recession in here, 90, 91, early 92 time frame, triggered by this improvement in the U.S. current account deficit. So often when the economists get what they ask for, we see bad things happen in markets. But what's also interesting is this really, we think, was the trigger for the 10-year bull market in the U.S. dollar. U.S. dollar bull market started right around here, late 91, 92 range, and ran for 10 years through 2002. We think this is really, we're seeing the same type of setup in here. We've seen a global stock market crash. The current account started improving here in late 2006, early 2007. Sure enough, it was the trigger for the credit crunch, and the global stock market crash is very similar to what happened here. Sure enough, we have a U.S. recession that has followed. Our guess is this will trigger a multi-year bull market. Not just this, a lot of the other things we look at in terms of where U.S. interest rates are relative to where they're going to be, given the relative growth in the U.S. and given the risk that is flowing into the world. Primarily at the moment, we see it very clearly in Europe, but I think we're going to see it towards the end of the year inside China. China has a massive bubble going on. China has made massive investments, fixed asset investments that are increasingly less productive for their economy. They have massive overcapacity in steel, aluminum, cement, and most of their other industries. Profit margin of the companies are wafer thin, and guess what? The U.S. consumer isn't rebounding because as this improves, that just means the U.S. Is buying fewer and fewer exports from China primarily. We think of them as the poster child. A lot of people believe that the emerging markets can take up this slack, but there's no way the emerging markets are going to run budget deficits up to 6 and 8% of GDP. The reason being, emerging markets don't want to run. Number one, they don't want to do it. They want to keep their fiscal house in order. And number two, they can't do it because if emerging market runs a major budget deficit, it exposes them much more than it does to the U.S. Because the U.S. is the world reserve currency, people have to hold dollars, and we have the deepest capital markets. We can fund and live with this problem of 6 to 8% current account deficits. The emerging markets of the world, although the growth is there, they're not going to replace the U.S., and they're not going to replace it until they develop a domestic capital market, and we don't see any of that really in any of the emerging markets per se. They're still highly dependent on flow out from the center to the periphery for funding. China has a lot of money, but they don't have a deep capital market they can fall back on. They need to continue to sell and sell and sell, from their export standpoints. China's put almost $2 trillion into their economy. Their economy is about $4 trillion size GDP, so they've pumped about 50% stimulus. 50% of their economy is stimulus in. They have massive bubbles in real estate, massive bubbles, I think, and so the problems are here, and you're seeing it here. If this current account doesn't come down and get very nasty again, China's in trouble. But as this current account continues to improve, which we think it is, it means dollar supply is coming out of the world. U.S. dollar index is a weekly trend, broke its weekly trend right here, has come down. This looks very much like the 2002 move. If you look at the 2002, when we saw a bottom in 1992 to 2002, we saw a move like this up in 2002, came down, bottomed again in 1992, bottomed again in 1995, retraced 91%, and then rocketed up in a 10-year bull market. This is a very similar move. The perma bears are very excited here. It's retraced over 80% of this move. Therefore, the dollar is going to go back into its massive bear market. It hasn't. It's turning. In the background, economic fundamentals and the correlations we look at suggest, again, the trouble in Europe. We think China will keep the music playing for the first 6 months of the year. They still have a lot of liquidity. There's still liquidity going into China. But we think towards the end of the year there's going to be a real risk event in China. So we think the U.S. can rebound on growth relative to the Eurozone in here, given what we see happening to the European Monetary Union, and maybe neutral, slightly better against maybe the commodity currencies, or maybe lag them a bit, but going to be supported. And if we get global growth, we think you're going to see interest rates hike up on the short end of the U.S. and help the yield differential. Then we think towards the end of the year, the U.S. is going to get another major move up because of the fact that we're going to see risk in the world from China. So that's our dollar view. And this is just some information on us. If you have questions, go to info@blackswantrading.com. These are the various newsletters that we have, subscription-based newsletters. The things that we do in this letter from a real recommendation standpoint, or we talked about here, are in this letter. We have a free global macro commentary. I think Steve had talked about that earlier. And we have a monthly issue too. This is a very short-term FX trading signal. It's very different from what I shared here today. But in this issue, actually this January issue of our monthly, we really built the case in detail, in much more detail than what I just shared with you, why we think the dollar is in a multi-year bull market. Steve?
Jack, thank you so much. You presented a ton of information in just an hour, so I'm sure that many people are either going to come back to the archives or, of course, sign up for your free currency currents. And again, you can go and do that at blackswantrading.com or send an email to info@blackswantrading. Jack will be more than happy to send you his free currency currents, and then maybe you sign up for one of his paid services. Jack, I see a lot of questions here, so let's just take a couple. Let's see. Let me see where I can find. John wants to know if the CRB is U.S.-based or international. Do you mind talking about the CRB, Jack?
When he says U.S.-based or international, I'm not sure what he means. It's just.
I guess he wants to know what makes up the CRB. I think.
Yeah,
so it's just broad commodities.
Yeah, it's a broad group of commodities: physicals, food, energy, those types of things in there. There's different components in there, and there's people sometimes prefer the Goldman Sachs index to the CRB for different reasons. One may be more weighted with energy, those types of things. But if you Google the CRB index, you can actually get a breakdown. I don't know that. But in general, we use it as just a basket of commodities that give us information.
Thanks.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.